Hello, good evening everyone. I CA Bhavna Grover from editorial team Taxmann. I am very pleased to welcome you all in our today's session on Ind AS 113, that is fair value measurement. Our speaker for today's webinar is CA Abhinay Gupta. CA Abhinay Gupta is a prolific speaker on IFRS, Ind AS, and has delivered more than 100 lectures at various platforms organized by multiple public and private bodies. He has also delivered lecture on IFRS and Ind AS at seminars for Reserve Bank of India and public sector employees organized by CAG. He is also empaneled as a technical reviewer with Financial Reporting Review Board, a committee of ICAI. I request all the participants to post their queries in the chat box available. Our team will address the queries and the selected queries will be addressed by the speaker after the session. Now I request CA Abhinay Gupta to take over the session. Please, sir.
Thank you, Bhavna, for the introduction. Good
Very
evening, everybody.
warm welcome to you on our platform.
Thank you. So, good evening, everybody. So, we are starting with Ind AS 113 fair value measurement today. So, this is the standard slide for the Taxmann about the services and the products Taxmann offers, like books, journals, online and offline research platform, tools for the TDS compliances. So it is the largest and most accurate online database on income taxes and international taxation, GST, company law, and SABI law, insolvency and bankruptcy code, FEMA, banking, NBFC, competition law, accounts, and audit. So as you are aware that you are using it for years now. So agenda for the session today is we will understand the objective of this standard first, why this standard has been drafted by ISB and adopted by the ICAI as part of the convergence of Ind AS. Then scope, what is the scope of this standard, what is the key definitions, and then the attributes which we will be using in the fair value measurement. And last piece is the disclosures. Now, the objective of this standard is to standardize the single source of guidance and improved consistency for measuring the fair value. So in the absence of this standard, people were using different methodologies, different mechanisms for arriving at a particular fair value for any of the financial asset or non-financial asset or liabilities. Now the standard is trying to standardize the mechanics used for arriving at or determining the fair value. So what the standard says, there are certain guidelines prescribed by this standard which will be used to measure the fair value. Then there are certain disclosures which are to be presented in the financial statements. So the objective is very clear: standardize the procedure of measuring the fair value, and certain disclosures are required for the benefit of users of the financial statements. Now, what is the scope? The scope is how fair value will be determined is governed by this standard, but for which asset or liability the fair value will be determined is not governed by this standard. So this standard simply says, if you want to measure a fair value, then only this standard will tell you how a fair value needs to be measured. But when fair value will be measured, for which assets or liabilities fair value will be measured, is driven by other Ind ASs. So for example, business combinations, Ind AS 103 requires fair value of assets acquired and liabilities assumed, contingent considerations, NCIs, or previously held interest. So it is 103 that derives the need of the fair value measurement. But once the need is there, how fair value will be determined is driven by this standard. So similarly, financial instruments, Ind AS 109 requires fair value for certain assets, liabilities, derivatives, or financial guarantee contracts. Other standards like employee benefits, Ind AS 19, intangible assets revaluation model, Ind AS 38, investments in associates, JVs, Ind AS 28, PP&D revaluation model and exchange of assets, Ind AS 16, non-current assets held for sale and discontinued operations, Ind AS 105, investment property, Ind AS 40. So all these standards requires fair value measurement for the assets and liabilities or the items they are dealing with. But They do not prescribe how the fair value will be measured. So this standard tells you or helps you in measuring the fair value for those items. So that is the scope of this standard. Certain exclusions are also there in this standard. So for example, Ind AS 102 share-based payment has its own fair value definition within that standard. Now, since the standard has its own fair value definition, so for the purpose of 102, 113 will not be applicable, neither for measurement nor for disclosures. So for both measurement and disclosures, 113 is not applicable on 102 related items and 116 leases items. Now, exclusion is related to disclosures only for Ind AS 19 employee benefits and Ind AS 36 for based on fair value less cost to dispose. So recoverable amount is required to be measured. Now recoverable amount says fair value less cost of disposal. So for that purpose, disclosure is not required by 113, but measurement of fair value will be required by 113. So this is the broad scope. So this standard tells you or answers you the question of how the fair value will be measured. Now, what is the definition of the fair value as per this standard? So the definition here is the price that would be received to sell an asset or paid to transfer a liability. Now, from the bold words, it is very clear that this is talking about the exit price. That is, I am exiting an asset, sell an asset or paid or to transfer a liability. So I am exiting either asset or liability. So whatever is the price, so is the exit price. In an orderly transaction, that is, the transaction shouldn't be distressed or forced by any regulator or the government or any other lenders. So this should be an orderly transaction between market participants at a particular measurement date. Now, as I said, fair value is the exit price. So now the question arises, what is the difference between entry price and exit price if the dealing is happening? So whatever is the exit price should equate to the entry price only, of course. So if on National Stock Exchange, there are buyers and sellers for Reliance Industries shares. Now, if seller is selling the share at say 2,000 rupees and the buyer is buying the share at 2,000 rupees, then only deal happens. So exit price will equal to entry price. But the standard uses the terminology sell an asset or transfer a liability. So that is the notion of the exit price. Suppose if the market is closed and at the closing price, the seller was asking for 2,000, but buyer was giving 2,199 only. Then 2,000, that is the ask price, would be considered for measuring the fair value. So because of the exit price we use, or a different mechanism, if there is a big gap between the bid and ask, so certain averages or mean can be taken. It is an orderly transaction that is based on marketing activities that are usual or customary for transactions and are not distress, liquidation, or for sale. So whenever we are measuring the fair value, we are measuring the fair value of the asset or liability from the perspective that it is sold independently without any distress sales. We are not considering those transactions which are happening under distress or liquidation or forced sale by any of the regulators or lenders. It is based on perspective of the market participants who are knowledgeable, independent, able, and willing to do the transaction. That is, the fair value is determined from the perspective of the market participants, and it is not an entity specific. So what is the difference? So the difference is, for example, under Ind AS 2, we measure the inventory at NRV, net realizable value. Now, NRV is not equivalent to fair value. Why? Because NRV is determined basis on the agreements to sale in hand by the entity. So that is the entity specific determination. But fair value is the open market price at which the asset or item could be sold. So that is not entity specific. It is the current value of the asset or liability at the measurement date and not the potential value at some future date. So we are measuring the fair value of the asset or liability on a particular date, and we are not measuring it basis on the any potential future date. So I am not saying that today's fair value cannot be tomorrow's fair value. Of course, suppose if a property, if there is a land or there is a property and now I got it fair valued from some fair value today, Of course, there are no significant movements or changes expected in next few days or next few months even. So fair value can be considered as equivalent to future dates. But the standard says it is measured on a particular date. Now, perspective of market participants here means is the assumptions that market participants would have applied while bidding for a particular item. So those assumptions we need to capture while measuring the fair value of that asset or liability. Now, what are the steps in this standard? So first of all, we need to identify unit of account, then assess the valuation premise, identify the market for basis of valuation, apply the appropriate valuation techniques, determine the fair value, and lastly, we will make the appropriate disclosures. Now, what does unit of account mean? So, if I want to measure a fair value for 100 shares of Reliance Industries I am holding today in my Demat account, then how I need to proceed? So, I will check what is the price quoted on NSE or BSE. Say 2000 rupees is quoting today for the Reliance Industries. Now, I am holding 100 shares, suppose. So, I simply multiply the quantity into the price. So, here the unit of account is 1 share. That is, I am taking the fair value of 1 share from the market and multiplying it to the quantity held by me as on date. So this is called the unit of account. So for any item, we need to first find out the unit of account for identifying the fair value, for determining the fair value of that item, and then whatever the quantity we have for that item, we will simply multiply. So this is the price into quantity concept. So this is the level of aggregation and disaggregation for the presentation and disclosure purposes as well in the financial statements. Now, what are the examples? Shares in the listed company, a derivative instrument, an outstanding loan. This is the standalone asset or liability. Now, there are chances that we have certain group of assets or liabilities. For example, portfolio of receivables, that is debtors. Portfolio of deposits, say security deposits or any other deposits. A CGU, cash generating unit. So I need to say what is my unit of account. So for example, there is a machinery which is usable only if there are certain other assets to be added in that particular unit, and then only machine can be made operational. So unit of account here could be a CGU, cash generating unit as well. So this is the unit of account concept. So this is the same question which I have just explained through the Reliance Industries share example. So if there is a share quoted in the market, then I simply take the price from the market and multiply by the quantity held. Now there is another concept is valuation premise, which is no more different from unit of account as well. So for non-financial assets, how the maximum value is derived, that is, if I use a group of assets together, then maximum value could be arrived, and basis on that I form the CGU, cash generating unit. Now that for that CGU I will determine the fair value, although the assets in that CGU are recorded in my FAR, fixed asset register, on indivisibility basis. Suppose there are 5 fixed assets which are forming the part of that CGU, but all those 5 fixed assets will be recorded in my FAR, fixed asset register, on individual basis, but still I will be measuring the fair value for that CGU because I am having the visibility of the future cash flows basis on the CGU. So I will arrive at the fair value of the CGU, then I will allocate the fair value to that particular asset for which I need to measure the fair value in that CGU. So this is how practically we fair value non-financial assets. Now, the next item is characteristics of the asset or liability. So when I am going to measure a fair value for a particular asset or liability, I need to understand what are the characteristics of that asset or liability which will be considered by the market participants for bidding the price for that. So condition and location of the asset, restriction on the sale or use of the asset are certain examples for the characteristic of the asset or liability. Now, if any restriction is there on any asset or liability, then that would be considered while determining the fair value. But if there are any restrictions on the entity which holds that asset or liability, then those restrictions or entity specific conditions will not be considered while measuring the fair value. So let's understand with an example. An entity holds an equity instrument that is a financial asset for which sale is contractually restricted for a specified period by limiting its transfer or sale to a qualifying investor. Is the restriction a characteristic of the instrument or entity specific restriction? And how we will measure the fair value? So here, entity holds the equity instrument for which sale is contractually restricted. So this contract has been undertaken between the entity and the third party. So the restriction is a characteristic of the instrument and would therefore be transferred to the market participants. So for this particular asset, there is a restriction casted on the entity that you cannot sell it to the qualifying investor. So that restriction will continue to be with the instrument. So fair value should be measured based on the quoted price for an otherwise identical unrestricted equity instrument of the same issuer that trades in the public market, adjusted to reflect the effect of this restriction which is casted on the entity to sell it to the qualifying investor. This adjustment would reflect the amount market participants would demand due to the risk relating to the inability to access public market for a specified period. Suppose if I am holding shares of a particular company which I got allotted through some special placement, and as per the shareholder agreement I have signed, I cannot sell these shares to a particular qualifying investors. So this restriction is casted, say, for 2 years. So for next 2 years, this restriction will continue to affect the fair value of these shares because they are not freely sellable in the market. So next concept is transportation cost to deduct or not in measuring the fair value. So what are the transportation costs? Suppose if I want to sell a particular asset and I have to transport it to a particular destination as expected by the buyer. Now those transportation costs, do I need to adjust while arriving at the fair value for that particular item? So the standard says generally transportation costs are not to be adjusted while measuring the fair value, but they will be adjusted if and only if the location is the characteristic of the asset. That is, the location is the characteristic of that asset or liability being measured. So let's understand with an example. Suppose a tea producing entity intends to sell tea by using a futures contract on Mysore Commodity Exchange. The contract calls for physical delivery to the Mysore railway yard. So that is there in the contract itself, the futures contract. Therefore, because the location of the tea is an attribute of the contract, the company should deduct the cost of physically transporting the tea to the sale location in the calculation of fair value. Suppose on Mysore Commodity Exchange, I have put that I have 100 bags of tea to sell and I am sitting in Delhi. But as per the futures contract, the delivery has to be made on Mysore railway yard. So for sending the tea bags from Delhi to Mysore, there would be certain transportation cost which I would be incurring, since I am taking the price from Mysore Commodity Exchange. Now that price needs to be adjusted for this transportation cost to arrive at the fair value of this tea in this contract. Now the next concept is highest and best use for non-financial assets. So Ind AS 113 says if there is a land and I need to fair value this land, then this land could be used for multiple purposes. For example, I can use it as a parking lot, parking space. I can use it for high-rise construction, residential or commercial. I can use it to construct a hotel or hospital. I can run a casino by constructing a casino there, or any other multiple uses. So standard says First of all, we need to see what are the possible uses which are physically possible, legally permissible, and financially feasible. Suppose physically possible. On this land, high-rise construction is not possible because of the ground soil test conducted by the engineers. So they say maximum 4 or 5 floors can be constructed. Beyond that, high-rise is not possible. So high-rise residential or commercial use is physically not possible on this land. Legally permissible. Suppose I want to run a casino on this land, but government doesn't allow to run casino. So that is not legally permissible. Financially feasible. Suppose I want to construct a Burj Khalifa on this land, but I do not have that much finance with me to construct Burj Khalifa on this land. So that is not financially feasible. So first of all, we need to filter out what are the possible uses by using these 3 filters: physically possible, legally permissible, and financially feasible. Now, whatever uses are complying with all these 3 conditions, those are the possible uses of this land. Now I need to see which use will give the maximum value out of it. So that would be considered as the fair value of this land. Now, this is a long exercise. Do I need to do the exhaustive search for all the possible uses? No. Standard clearly says you don't need to do that. Then what exactly I need to do? So standard says, although best possible use, highest and best use should be considered for measuring the fair value, but it is assumed that entity is always prudent to use its assets in its best way. So whatever is the current use should ideally be considered as the best use unless there is a contrary view. So now the task is simplified. So whatever is the current use is assumed to be the best use unless there are contrary view available. So highest and best use is always considered when measuring the fair value, even if the entity intends a different use. Now, highest and best use for non-financial assets can be either on a standalone basis or in combination with other assets or liabilities. That is either the individual asset or liability or a combination of assets or liabilities. That is the CGU concept. So same concept applies either on individual asset or group of assets. Land acquired in a business combination is currently deployed for industrial use as a site for manufacturing facility. Nearby sites were recently developed for residential high-rise. It was determined that land could be used to develop residential high-rise. Now, how the highest and best use would be determined in this case? So in this case, highest and best use is determined from the higher of the value of the land that is used for manufacturing operations, that is its current use, and the value of the land as a vacant site for residential use. Now we will calculate what is the value which we will arrive through these 2 uses, and accordingly the fair value will be measured basis on the highest value out of these 2 uses. Now, transformation cost, like cost to demolish the manufacturing facility, would be considered in the value of the land as a vacant site. So if there is some construction over the land which I am not intending to use, so definitely while measuring the fair value of that land, I would say I need to incur so much expense to clean the land, so that I will deduct from the price I would be quoting. So fair value will get adjusted for that additional cost which I would be incurring for a different use. So let me see if there are any questions. So first question is, does the receivable means loans, portfolios for banks? Yes. So it can be any financial asset or financial liability. Could you please link with this Ind AS, with the Ind AS 16 and Ind AS 40? Sure. So Ind AS 16 says fixed assets can be measured on cost model or revaluation model. So if entity opts for cost model as an accounting policy choice, then 113 is not required, because I'm not revaluing my fixed assets. But if the entity opts for the revaluation model, then I need to determine the fair value for those fixed assets. Hence, fair value will be determined in accordance with 113 only. And once it is determined, I will be using it for Ind AS 16 for those fixed assets and depreciating over that fair value for the remaining period of those fixed assets. The last is in the topic highest and best use question was who will take contrary view? Auditors? No. So auditors are not into picture as of now. It's all about management. So it's management responsibility to determine the fair value for its assets or liability. Now management will do the brainstorming that boss, I am using this land for the industrial operations. Now, if I want to measure the fair value, should the industrial operation is the best use? So they will do the brainstorming. What are the nearby lands are being used for? All those assessments has to be carried out by the management, and then fair value will be determined. Then thereafter, auditors will come into the picture and will ask on what assumptions and basis you have arrived this fair value, and management has to answer all those things. So auditors are not here. Okay, so that was the last question. Now, the next concept is principal market and most advantageous market. Now, what standard says? Standard says, boss, there are two types of markets, principal market and most advantageous market. Suppose National Stock Exchange, NSE, has very high volume as compared to BSE for any of the stocks listed on both the exchanges. So, in this case, principal market would be, say, NSE, National Stock Exchange, because that records the greatest volume and level of activity for the asset or liability on any day or throughout the year. However, there are chances that Reliance stock is quoting at 2000 on NSE, but is quoting at, say, 2020 rupees or 2010 rupees on BSE. Now, if you are holding Reliance shares, on which exchange you would prefer to sell? Of course, on that exchange where the price is higher. So, where the price is higher, irrespective of the fact that volume is low, most advantageous market would be the market where net proceeds coming to you are higher. So, I'm not saying the quoted price is higher. I'm saying net proceeds coming to you are higher. Okay. So, let's understand it with an example. Suppose there are three markets, market A, market B, and market C. Now, annual volume is in market A 30,000, market B 12,000, market C 6,000. Transactions per month 30, 12, and 10. Price 50, 48, and 53. Now, transport cost 3, 3, and 4 say. Quoted value is 47, 45, 49. Transaction cost is 1, 2, and 1. And net proceeds are 46, 43, and 48. So, this is the scenario. Now, if you want to measure the fair value basis on principal market, then what would be the fair value? First of all, which is the principal market? Principal market is that market where the volume is highest. So, which market is principal market? Market A. So, principal market is market A. Now, what is the fair value in market A? Fair value in market A is 47. That is the quoted value. After adjustment of transportation cost, assuming that transportation costs are part of the contractual obligation. Otherwise, fair value would have been taken at 50 if that is not the case. Now, 47 is assumed to be the fair value here. So, principal market is market A and 47 is the fair value. Now, what is the most advantageous market? Most advantageous market is that market where net proceeds are highest. So where the net proceeds are highest, 48. That is the market C. So market C is the most advantageous market. What would be the fair value? 48 or 49 or 53? So ideally 53 is the fair value. But if transportation costs, as I previously mentioned, are part of the contractual obligation, then those are need to be deducted for calculating the fair value. So fair value would be 49 in that case. And 48 is the net proceeds only. So this is the answer. So market A is the principal market. Fair value is 47. And market C is most advantageous market and fair value is 49. Here, fair value 47 and 49 are computed after deduction of transportation cost, assuming that transportation costs are part and parcel of the contract. Had that not been the case, then I would have taken 50 and 53, that is the quoted price in those markets, as the fair value as required by the standard. Hope the illustration is clear. If there is any question, just throw it right away, otherwise I will proceed. So there is a question, how does the fair value determine highly volatile security market? That is a altogether advanced level of question I will take separately, because this is the basic standard coverage here. So the concept of principal market is clear, concept of most advantageous market is clear. Now the question comes, do we have the free choice to take the fair value from any of the markets? So standard says you do not have free choice. If principal market exists, then fair value of the principal market can only be used. That is, most advantageous market cannot be used if there is a principal market. However, if there is no principal market can be identified because the level of volume or activity in all the markets is almost similar, then most advantageous market can be used and the fair value basis on the most advantageous market can be taken. So point is clear, there is no free choice to use the fair value of the any of the market. So if principal market does not exist, then only I can go to use the most advantageous market's fair value. So here it is mentioned, Ind AS 113 does not permit the use of price in the most advantageous market if the principal market is available. It is not necessary to perform exhaustive search for all the possible markets to identify which market is the principal market and which market is the most advantageous market. So I am not going to prepare a list of all the markets, say National Stock Exchange, Bombay Stock Exchange, Delhi Stock Exchange, Calcutta Stock Exchange. So I am not going in those things. I am only saying that I do generally trade in, say, NSE and BSE. So for me, these are the two markets. Now, where entity transacts in various markets, it should document which particular market price is used. So if entity is transacting in multiple markets, then which market's fair value is being used, they have to document. Now, the concept of transaction cost. Is there any question? Initially, there was a principal market. Later, there is no such market. Then what? So if initially there was principal market, now the principal market is no more principal market, and I can conclude it, boss, on the measurement date, that is on the date of measuring the fair value, there is no principal market, although it was there earlier, then I can use the most advantageous market. So I need to check on the measurement date. On the measurement date, if there is a principal market, I am bound to use principal market's fair value. If there is not, then I can use the most advantageous market. Now, transaction costs. So transaction costs are incremental direct and essential costs, that is, would not be incurred if no decision to sell. So transaction costs are those costs which will incur if and only if there is a decision to sell, otherwise they are not incurred. So these are linked to transaction. If transaction is happening, transaction cost is being incurred. If transaction is not happening, transaction cost will not be incurred. For example, stamp duty. If I am selling the shares, I will be paying the stamp duty. If I am not selling the shares, I will not be paying the stamp duty. Considered in determining the most advantageous market? Yes. So for determining the most advantageous market, I use the word proceeds, net proceeds. So net proceeds means after eliminating all the transportation costs, all the transaction costs, net proceeds, but not considered in measuring the fair value. So fair value is not linked to the transaction cost. So fair value is the fair value of that asset or liability, irrespective of the fact there are different transaction costs in different markets. Okay, so fair value is not affected by the transaction cost. Any question on the transaction cost concept? I guess I haven't received yet any. So let's proceed with the concept of liquidity. Now, liquidity is a very vast concept, and it is still under discussion at ISB level, who have drafted the IFRS basis on which we have converged version of Ind AS. So it requires lots and lots of inputs from the valuation experts, how the liquidity needs to be considered and incorporated in the valuation of the asset or liability. So I remember one of the question was there, volatility. So volatility, liquidity. So these are the high-end concepts, which are very, very, very judgmental. There are lots of inputs required to, give adjustments for to the fair value determination relating to these factors. Now, for example, I am holding the shares of a company which are very, which are traded in very less quantity. Suppose I hold 1,000 shares, but the daily trading volume is say 200 shares. And I am not able to sell 1,000 shares because there is no volume to absorb my sale. So would the liquidity be considered, or the fair value basis, would the fair value will be affected by this factor? The question is this. So the answer is, if there is a quantity to be offloaded in the market is higher than the absorption power of the market, and because of that price is say nose diving, then do I need to consider the price before it falls, or do I need to give adjustment for this fall because of the heavy quantity I am offloading in the market? So standard says I need to consider the fair value of one share without considering the factor that I am having huge quantity which I can offload and drive the price down. So that is not required to be considered, or that is not going to affect the fair value. So fair value will be considered for one share and multiplied by the quantity, that is the unit of account. But suppose if I am not able to sell the shares of a particular entity because that is not listed on the stock exchange, say this is a private limited company. Private limited company is not listed. Now I have shares of a company which is listed and one which is not listed, but they are in the same business. So I will take the price of the listed entity, say what is the price quoted for the listed entity, and will do certain adjustments and arrive at the fair value of the unlisted entity. So that is the mechanics followed by the fair valuation experts. Now here liquidity will be considered because my holding of private limited company is not liquid enough to sell it upfront as and when I desire. So that liquidity factor needs to be considered while measuring the fair value. So for listed entities, fair value is the price quoted on the stock exchange, and for unlisted entities, the price is fair value of the comparable entity quoted on the stock exchange with adjustment to this fact that these are not saleable upfront. So that adjustment has to be devised by the valuation experts and applied for determining the fair value. So of course, fair value of a private company would be lesser as compared to the price of the listed company, assuming business size, scalability, product, everything is same for both the companies. So here is the example which I have just explained. So investor X holds say 10% investment in a private company Y classified as an FVTOCI investment under Ind AS 109. It values by using a market multiple of recent earnings of a comparable listed entity Z. Should this valuation be adjusted for illiquidity of Y share as compared to Z? Yes, because Y is private company, not listed, Z is a listed company. So this factor has to be considered for determining the fair value. Now, the lower price X is likely to get if X sold the entire 10% investment in a single shot rather than if it is sold its shares in Y in smaller batches. So that factor we will not consider because for us unit of account is 1 share. So we will not consider that price will go down if I sell the entire holding today because there are not enough buyers in the market. So that factor we will not consider for determining the fair value. That is crystal clear by the standard. Any questions on this? I'm not receiving any question, so I'm proceeding. Now the next concept is orderly and disorderly transactions. So as I mentioned, that transaction should be orderly. If I can prove it that transaction was not orderly, then fair value will not be considered basis on these disorderly transactions. So exposure to the market for a period before the measurement date to allow for marketing activities that are usual or customary. So what does orderly mean? Orderly means that asset was available in the market for the reasonable period and buyers were intimated through some marketing activities that this product is available for sale, and buyers were given a reasonable time period to come up with their bidding for that particular set. So that is called the orderly transaction. Now Ind AS 113 assumes an orderly transaction at a measurement date that the transaction involves market participants that are willing and motivated to transact but are not forced or compelled. So in a recent example, suppose if there are any lenders which are asking the company to pay the dues, and the company is selling their assets in hurry burry just to make the payments to the lenders, then those transactions are considered as a forced or compelled transaction. So we are not taking those transactions into our consideration while arriving at the fair value of that particular set. Unlike an orderly transaction or in a distressed transaction, market participants are compelled or there is no or little exposure to the market. So those transactions we cannot consider for benchmarking the fair value of the similar asset. Now, circumstances that may indicate that transaction is not orderly: inadequate exposure to the market, marketed to a single market participant. I did not give chance to market participants to participate in the bidding process, and I simply negotiated the deal privately with one of the buyer. So that is not orderly transaction. Seller in or near bankruptcy or forced regulatory or legal requirements like ADAG Pack, Anil Ambani Group. If they are selling any assets to make the payments to the lenders, then definitely those transactions would be considered as forced or distress sale transactions that cannot be benchmarked. Now, transaction price is an outlier. Suppose market participants are bidding for a particular asset, say 1,000 rupees for that asset, but the transaction actually taken place at say 1,500 or 2,000 or 500, then that transaction price is an outlier. So there is certainly something wrong with the transaction price, and if transaction price is an outlier, we cannot consider that transaction for measuring the fair value for similar assets or liabilities. So that is about orderly and disorderly transaction. A significant decrease in volume and activity within the market does not mean that all transactions are not orderly. Further analysis need to assess their relevance. When COVID has arrived in 2020, so FIIs started selling the stocks aggressively, in fact, very aggressively. And price was coming down, but volume was not there. So volume has decreased because there were no buyers because of the fear factor at the time. Nobody was ready to buy the stocks. Everybody was selling the stocks. So buyers evaporated, sellers are increasing. In that case, volume is not taking place because the transaction is not taking place, but the lower circuits are happening continuously and the price is nosedived. What we will do in that case? Further analysis. That is high volatile environment. We need to understand other factors first, and then we will arrive at fair value. Less weight should be placed on transactions without sufficient information to conclude whether the transaction is orderly compared with the other transactions that are known to be orderly. So we have to be prudent. We have to be knowledgeable about all the facts and circumstances while measuring the fair value, and we will assign less weights for those transactions where sufficient information is not available with us to conclude whether those transactions were orderly or not orderly. So we will not consider those transactions, or if we want to consider, then less weightage would be given to those transactions. So let's understand an example. A private investor pays 25 million to purchase a rare painting at a public auction. The seller had advertised the sale of the rare painting for 6 months. 6 months prior to the event. Event means the sale event. A total of 15 individuals placed bids on this rare painting during the public art auction. All bidders were provided with the same information and ability to view the rare painting prior to the public art auction. Is this an orderly transaction despite the supply and demand imbalance for the rare painting? This is the first question. What if the rare painting was marketed solely to one buyer, that is a particular museum? This is the second question. So what do you think, participants? This transaction is orderly transaction or not? Just say yes or no. So the answer is yes. This is an orderly transaction because equal information, equal opportunities were provided to all the participants or individuals who were interested in these paintings. However, if this painting was not, put in the museum for getting the bids, but marketed solely to one party, then that would not be considered as a orderly transaction because that is sold privately to one party. Now, the another concept is active market and inactive market. The determination of whether the market is active or inactive affects the extent of judgment that management can apply. For example, few recent transactions. Price quotations are not developed using current information. So same factors used to determine if the market is inactive can be used to assess whether there has been a significant decrease in equity. This is based on the weight of the available evidence and relevance. So if the transactions are happening regularly in a market for a particular asset or liability, then that market is active. If the transactions are not happening regularly, then that market may be regarded as inactive because there are certain transactions, few transactions. Okay, so we can regard that market as inactive. So inactive market we cannot use for our purpose of fair value measurement. We only go to the active markets where the transactions are happening regularly or with reasonably decent volumes. Now, once we are done with the unit of account, once we are done with the valuation premise, once we are done with the identification of the market, that is the principal market or the most advantageous market. Okay, once we understood what are the attributes or characteristics of the asset or the liability, thereafter the concept comes which valuation technique I'm going to apply to measure the fair value. So standard prescribes 3 valuation techniques. Number 1 is the income approach, that is the discounted future cash flow DCF approach. Number 2 is the cost approach, that is the current replacement cost. And number 3 is the market approach, that is the price and other relevant information. So these are the 3 approaches. Are there any other approaches as well which we can use? If there are any, you can use. This is the list prescribed by the standard, and a standard doesn't say there cannot be any other approach. Now, use valuation techniques that are most appropriate in the circumstances or for the asset or liability into consideration. Have sufficient available data, maximize the use of relevant observable inputs, and minimize the use of unobservable inputs. What does it mean? So which technique I am going to use? Income approach, cost approach, or market approach? First of all, I need to answer myself whether I have the available information sufficient available data or information which I have to consider for this particular approach. Say, for example, income approach. Do I have the projected cash flows for the future periods? If the answer is yes, I can consider income approach. But if I do not have the future projected cash flows, then of course I cannot apply the DCF. So DCF is eliminated. Then I will go to the cost approach. Current replacement cost. What does that mean? That means suppose if there is a power plant and I want to fair value the power plant. Now I'll ask the contractor who can construct a power plant similar to what is already constructed, which is available for sale. So I will ask the contractor if I give you order to construct the same configuration power plant, same size, same configuration, same material, same capacity, then what would be the cost? That is called the current replacement cost. Suppose the contractor comes to me that, boss, I will construct the similar power plant for say 1000 crores. Now, does this mean that the power plant which I am going to fair value is of 1000 crores? Possibly yes, possibly no. Why possibly yes? If it is recently constructed, say 6 months back only, then there is no significant wear and tear or depreciation should be there. So I can safely assume that whatever the price contractor is quoting to me for the constructing a second power plant of same size, same configuration is ideally the fair value of this power plant. Number two, if this power plant is 10 years old, then would that still be hold good? No. In that case, I will apply on this 1000 crore quotation from the contractor to construct the similar power plant and apply the depreciation for the wear and tear for this plant which is 10 years old. Then that would be the fair value. So this is called the current replacement cost. Now the third is market approach, price and other relevant information. Suppose if I want to sell this power plant, then what is the price I am getting from the interested parties or willing market participants? So that is called the market approach. The real estate business uses generally the market approach only. So if we go for buying say 3 BHK, 4 BHK or any commercial complex, then generally the property dealer tells boss, this is the latest, these are the latest deals available with me, and the same BHK or same in the same society I have sold it last month for say 2 crores. So 2 crores is the fair value. So that is called the market approach. So these are the three approaches. Which approach I will be using depends what item is to be considered for the fair value. Number two, what information and data I have. Suppose if I have the future cash flows, I can use income approach. If I have the quotation from the contractor available for the item under consideration, so then I can use the current replacement cost approach or market approach if market prices are available based on the recent transactions happened for similar item or the same item. So that is the thing. If there are any queries, let me check. No. So this is all about the valuation techniques. Whatever the examples I have given are well explained in these slides. Say market approach uses the market transactions, recent market transactions, often used for real estate business. Property dealer generally uses this approach, and it may also be used as secondary approach to evaluate and support the conclusions derived using another approach. Of course, suppose if I have applied a DCF, a discounted cash flow approach, because I had sufficient information available with me, then whatever the fair value I have arrived through DCF, I can corroborate it with an evidence from the market approach basis on the recent transactions for the similar price. So if there is a big gap between the fair value determined as per the DCF approach and fair value basis on the market approach, then definitely I need to see if there is any wrongful I have done in the DCF approach, or is it something that market participants are having some extra knowledge about the product which I do not have. So different approaches can give a different fair value. So I can corroborate it with each other. Cost approach, same example, property, plant and equipment, power plant I have just taken. And the income approach, DCF approach, generally used to measure the fair value of the liabilities, intangible assets, business and financial instruments not traded in the active market. So this is all about the techniques available. Now, if a transaction price equals fair value at the initial recognition, Calibrate valuation technique to this price at initial recognition. Apply valuation techniques consistent. So these are the other rules prescribed by the standard, that when you are using the valuation techniques for measuring the fair value, what are the other things to be considered. So change in valuation technique needed if new market develops, new information becomes available, market information previously used is no longer available. Suppose I was using the market approach for the shares I have in my demat account because those are listed on the stock exchange, but now they are no more listed. So if they are no more listed, then in that case, what would happen? I will simply not be able to use the market approach because market price is not available, quotation is not available. So I will use another approaches. Then I will ask the management of the unlisted company, because now this is unlisted, to give me the future cash flows. I can use the DCF approach. So if there are changes in the information available or circumstances, then the changes in the valuation techniques will be required. Now, whenever I change the valuation technique, does that change is treated as a change in accounting policy or change in accounting estimate? So change in valuation technique is equal to change in accounting estimate. So that is not a change in accounting policy. Accounting policy is what? I am measuring fair value is determined by DCF approach or market approach or replacement cost approach is change in estimate only. Now, there is a fair value hierarchy prescribed by the standard. So level 1, level 2, level 3. Level 1 is the most reliable by the investors, bankers, lenders, etc. and users of the financial instrument, because this is based on the quoted prices available in the markets, like stock exchange price for the shares. Level 2 is inputs other than the quoted prices. So prices are not quoted on any of the exchange. So I will use other inputs which are observable, like interest rates, yield curves, which are observable. Level 3 is unobservable, like growth rate applied by the management. So management expects that sales will grow by 20% CAGR for next 5 years. So that is the growth rate assumed by the management. That is not observable input. So if the fair value is determined basis on the quoted prices, that will be classified and disclosed in the financial statements under level 1 category. If that is computed basis on the inputs which are not quoted prices, that is interest rates, yield curves, etc., that will be classified under level 2. And if the fair value is determined basis on the unobservable inputs as well, then that would be classified as level 3. Income approach value 100, cost approach 200. Should I take average of both? So first of all, you need to go back and check your income approach, because difference is significant. So there is certainly something wrong with the income approach you have applied, because difference cannot be like 100% difference, 2x difference. And if it still persists, then definitely you can take the mean, median, or average of it. But that is I'm sure this difference is too much. Income tax that says fair market value is income tax that says fair market value. Is there any difference between fair market value and fair value? So standard Ind AS 113 defines fair value for accounting purposes. For Income Tax Act purposes, fair market value, of course, that is the fair market value basis on the market approach only. So that is similar to the fair value, but not the same. So that is the fair market value as per Income Tax Act, and this is the fair value arrived using either of the any of these three techniques. That is the fair value. Now, valuation must be based on the quoted prices of an identical asset or liability traded in an active market if available. Valuation techniques must maximize the use of relevant observable inputs and minimize the unobservable inputs. So what does this mean? So standard says always try to use the quoted prices as a best policy, because quoted price, which is determined basis on the play of demand and supply, is the best thing to value any item. But if quoted prices are not available, then use the quoted prices of an identical asset or liability. Suppose I am doing the fair value of a particular asset for which is not traded in the market, but a similar identical asset is being traded. So I will use the quoted price of that identical asset and adjust to arrive at the fair value of this asset under consideration. Now, standard says valuation techniques must maximize the use of relevant observable inputs and minimize unobservable inputs. So management forecast of sales, management assumptions should be minimized, and whatever is observable should be maximized. Suppose past trend says management was able to grow sales by say 3% CAGR, but management is saying for next 3 years CAGR would be 20%. Now, observable thing is the past trend, unobservable thing is the management future forecast. Now you have to do the brainstorming with the management, understand the reasons. Did they incur some massive capex basis on which they are projecting 20% CAGR? So all those things needs to be understood first, and if it is justifiable that for next 3 years 20% CAGR is there, then definitely that input can be taken into consideration. But standard says try to use the maximum observable inputs. Multiple inputs might be categorized in different levels of a hierarchy. The overall fair value measurement is categorized in the hierarchy at the lowest level input that is significant to the entire measurement. This requires judgment. Any other question? Is the net realizable value under Ind AS 2 is equal to fair value? No, never. NRV is different, fair value is different. NRV is entity specific, fair value is dependent on the market participants. No correlation. If 3 approaches of valuation can be used sufficiently, then which can be used? Okay, so you are saying for a particular asset or liability, all the 3 approaches can be used sufficiently because you have all the sufficient information and data available with you. Then market approach is the best approach to be used, as highlighted by point number 1. Valuation must be based on the quoted prices. If market approach is there, quoted prices are there, that is the best thing to do. Adjustments to arrive at measurement based on the fair value are not considered when determining the fair value in the hierarchy. That is fair value less cost to sell. So fair value is the fair value. Fair value is not the fair value net of transaction cost. So fair value is fair value, no adjustments. So that is all about this standard. Before running through the disclosures, I would like to answer the queries if there are any. Otherwise, I will proceed with the disclosures and wind up the session. So I'm not getting any further queries. So let me take you through with the disclosures. Now, disclose information that helps users. So disclosure is, of course, for the users of the financial statements. What I need to disclose, which valuation technique I have used, which inputs I have used to develop those measurements. Am I using unobservable inputs level 3? If yes, what is the effect of those inputs on the measurements on the P&L or OCI, as the case may be? Suppose if I'm measuring the fair value through P&L or OCI, that is as an accounting policy choice, I need to explain. Fair value disclosures are required separately for each class of assets and liabilities. For each class of assets and liabilities, you need to disclose the fair value. Quantitative disclosures are presented in tabular format. You cannot write in paragraphs. So standard specifically is asking that wherever the quantitative disclosures you are presenting, you have to present them in the tabular format. You cannot draft a para and put the numbers in the para itself. So this is the suggested format which can be used for disclosing. Now, fair value at the end of the reporting period, reasons for the measurement of fair value, level at which in fair value hierarchy, amounts of transfers between level 1 and level 2 in the subsequent years or subsequent periods, or the back movements. If the highest and best use differs from the current use, that fact. Suppose there is a different use which can be regarded as a highest and best use, then that needs to be disclosed here along with the reasons. Now, for level 2 and level 3, a description of the valuation technique and the inputs used, which valuation technique you have used, what are all inputs considered for determining the fair value, Any changes in the valuation techniques? If yes, reasons why there is a change. Earlier you used market approach, now you use DCF approach because in previous year shares were listed, in current year shares are unlisted, so I have switched to DCF approach. So that could be the valid reason. For level 3, quantitative information about significant observable inputs. Level 3, description of the valuation processes. Reconciliation, you have to present opening balance, gain or loss recognized in the P&L or OCI in the current period or current year, purchases, sales and settlements, amount of transfers among the levels, level 1 to 3, reasons for the transfers, and accounting policy for determining when the transfers occurred. Narrative description of the sensitivity to those unobservable inputs, like management has given you a 20% CAGR for sales growth. Now, if I need to do sensitivity analysis, say 5% minus 5% plus, so 15%, 25%, what would be the impact on my overall fair value? So those sensitivity analysis disclosures needs to be presented with a reasonable range bucket, interrelationships between the inputs and other unobservable inputs. For financial assets and liabilities, disclose if changing one or more observable inputs would change the fair value significantly. So if there is any impact of any particular input, say discount rate, future growth rate, CAGR, is material enough that a slight change in the attribute may result into a significant change in the fair value, that fact needs to be disclosed along with the change impact. So that is all about disclosures you need to present. You can refer to any of the listed companies' financial statements to see how the disclosures are being presented, so that you have a practical idea how these disclosures are actually translated. So that is all about from me for today on Ind AS 113. I hope you enjoyed the session and it was informative enough for you. So thank you once again.
Thank you, sir, for such a wonderful deliberation. That was really fruitful for us. Now I request the participants, if they have any query, they may post it in the chat box, else we may end the session.
Now I am able to see the chat box itself, so probably I would answer here directly. Okay, latest one is on the top.
I think no more questions now.
I'm happy to wait for next 2-3 minutes as well.
Yeah.
Nobody's,
Is there any scope
typing.
for research?
Is there any scope for research to be? I didn't understand what exactly.
Yeah, the question is incomplete, I guess.
For undertaking research, is there any scope? I am still not able to get what exactly you are trying to ask, Jilan.
Is there any scope for undertaking research? For research to be undertaken? Yeah.
What sort of research?
Yeah.
I'm sorry, I'm not able to understand. So I think I'm not getting any queries. Is there any scope for undergoing PhD? I'm not.
Sir, can you please elaborate your question? As we are not.
I'm not aware about this. If there is any PhD course available for fair value measurement. Of course, there are valuation courses which are done by the valuation experts. So this is the accounting standard. This is not the valuation standards. So if you are talking about the valuation research, then definitely there are some courses available. How the valuation is being done. But this is the accounting standard for measuring the fair value.
One more question. Are you sharing the presentation? Yes, sir. The presentation and the recorded session will be available to all the participants on their email ID.
So let's wind up. I'm not getting any queries. So thank you, Bhavna. Thank you,
Yes,
participants,
thank you
for
so much,
listening
sir.
patiently.
Thanks to all the participants as well
Okay,
for the
bring
participation.
it off.
Okay, okay.